Yo, what is going on, guys? Today we're going to be going through how to correctly use rejection blocks. Now, let's get straight into it. Most people make a common mistake, which I also did when I first started using rejection blocks, is a candle would close bearish and then they would use the bullish wick as a bearish rejection block, vice versa for bullish. Or you might see something like this. People mark out the rejection block to take longs when you take shorts from a bearish rejection block. So in order for a bearish rejection block to be formed and for it to be valid, let's assume that it's rejecting off of a PDRA or liquidity sweep already. It must have a rejection wick from the PDRA or liquidity sweep, and it must close as a down closed bearish candle for a bearish rejection block to be viable. And then you would just simply mark out from the body to the wick high. You would mark out your rejection block, and then we'll get into this more later, but the CE is a much better entry point. If you can see price come and retest the CE, that gives you more confluence than it just coming to retest the rejection block zone. We'll also later on in the video get into how you can use the Fibonacci tool to refine your entries even more, but vice versa on this example for a bullish candle. For a bullish candle to be viable, it has to be rejecting off of a liquidity sweep or PDRA, some sort of significance. It can't just be a random wick and you say it's a rejection block. So we reject off of something, same as the bearish candle, but bullish. We reject off of a PDRA or liquidity sweep or something. And then for a bullish candle to be a viable rejection block to take longs off of, it must be closed to the upside as a bullish candle. You can't have a bearish wick, it closes to the downside and then you take that for longs. It's not viable. You would then, same way as before, mark out from the body to the wick. CE is a higher conviction entry zone, same as I went through with the bearish candle. To get more refined entries, you can then, with a bearish candle, a bearish rejection block, mark out from the high of the wick to the body of the wick. You mark out then the rejection block. If the golden zone here, which is the 0.62, 0.705, and 0.79, align with the CE of the rejection block, it's the utmost confluence for this setup. Obviously, a lot of the time, it's not going to be on this body. It might be like, if we create more lows, maybe a higher low, a lower low, whatever, you would trail this. You would trail the bottom of your Fibonacci tool to each new low created. And then you stop trailing it when we retest the rejection block. So let's say we kept on coming down in price to here, and then it retraced. The golden zone would now be slightly below the CE, so it's not as good confluence. But the closer the golden zone is to the CE, the more tight your limit order can be, because you would then set a position on the CE because it's in the middle of the golden zone. Put your stops at the top of the rejection block and you could target whatever liquidity you want. Whereas if we trailed the Fibonacci tool because we kept on coming down and then we put our limit order at the golden zone, then we'd have a much bigger stop, smaller risk to reward, and then not as good of an entry. But you might think, oh, why can't you just set a limit order at the CE even if it's not in the golden zone? Sometimes it works, sometimes it doesn't. That's why I've just tried sticking to keeping into refined entries, because it's happened more often than not where price would come up, tap into the golden zone around this area, not hit CE, and then flush to full TP and I missed the move. So again, Vice versa for a bullish candle, you'd mark out like this. This time you take your Fibonacci tool, mark out from the wick low to the body high. If the golden zone aligns with CE, got a better entry point because price is most likely going to come and return to that area before retracing. And then again, if we just kept on pumping up and up and up before retesting the rejection block, you'd have a much bigger stop loss, a worse risk to reward, and not as good of an entry. So now let's get some examples on the charts. Here is an example from yesterday. Obviously, this rejection block strategy is normally paired with 10 a.m. open, but I'm not focusing on the full strategy right now, just purely on rejection blocks. So right here, you can see we come down, tap into a 1 minute fair value gap, which was also stacked on top of a 3 minute fair value gap. We then rejected off of it, closed a bullish candle. So this is now a bullish rejection block. Yes, it got filled here. We came up, came back down. We're going to forget about this part for now. You grab the Fibonacci tool, the low to the high, and then you trail it to the most recent high. This is the most recent high before we come back down. Then this is the most recent high before we come back down. Trail it. Then boom, right here. Now, you could have entered off of this candle retesting the rejection block, but because it didn't retest the CE, that means there's not as much confluence, and we can safely assume that there's a likelihood that price will come and tap the CE. So we would want to look for an entry where the CE is our limit order. Right here, the golden zone is still within the rejection block. Right here, it wouldn't be. Golden zone is out of the rejection block. That's why I wouldn't have taken this. Right here, though, the golden zone's still in the rejection block. And then you could either put your limit order at the golden zone and then stop loss at the bottom of the rejection block and then target any of this low resistance liquidity because we just swept out all of it. Or you could put your limit order directly on the CE. In that way, you'll have a smaller stop loss, bigger risk to reward. You'll be making more. Target all the low resistance. This was a beautiful setup. Now, I'll show one more example. In this case, it'll be a bearish example. Second, here is another example from yesterday. In this case, a short, a bearish rejection block. So you can see here, we was rejecting off of a 1 hour gap right here. Then we also had 15-minute highs built up, as well as this one right before the rejection block. We came up, swept out the high, which was this candle here. Swept out the high, created a bearish rejection block. You mark out the rejection block. Then with the Fibonacci tool, mark from the high of the rejection block to the low. You can see the golden zone is all still perfectly within the rejection block, and the 0.79 range is nearly in line with the CE, so this would be a much better setup. Put your limit order at the 0.79 range, stop loss at the rejection block. Then you could have just targeted this unfilled 15-minute, this unfilled 15-minute, and then all of this liquidity. If we targeted the unfilled 15, that would have been an 11 risk to reward. One main mistake that I see people make a lot is thinking everything is a rejection block. Let me find a quick example just live on the chart here without finding it before. So we got a big bullish wick right here. Some people would mark this out as a rejection block. Why is it not a rejection block? It's not rejecting off of anything. This is not a low because that is two bullish candles next to each other. This is the low, and this already swept it. So this would be the rejection block. And then again, it doesn't mean it's always viable. We're in the middle of a bunch of chop. It was just a random sweep, and then it formed a rejection block. It doesn't mean it's a good one to take. So I hope that helps if any of you are struggling with rejection blocks, or if you're new to learning. If there's anything else you want me to go over more, or some things you're struggling with, let me know, and I can see if I can help out.